Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is fast food's most lovable restaurant a good investment? In this video we will be analyzing if Jack in the Box stock is a buy. Could Jack in the Box, stock ticker symbol JSEK, be ready for a rebound? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Jack in the Box. Jack in the Box was founded in 1951 by Robert Peterson in San Diego, California, offering a classic fast food menu with burgers, fries, tacos, and of course, their signature late-night munchies. Jack in the Box is also known for pioneering some fast food staples, like the breakfast sandwich and portable salads. After going public via IPO in 1987, growth continued to accelerate. Today the company has over 2,200 locations and around 22,000 employees, including the famously lovable big-headed Jack mascot. Now let's look at the price action. Starting with the 1-year chart, we see that Jack in the Box had a CAGR of about -44%. Zooming out to the 5-year chart, we see that Jack in the Box had a CAGR of -7%. Jack in the Box share price had been in a steady downtrend for some time. Ouch. If we perform a backtest comparison of investing $10,000 in Jack in the Box versus the S&P 500, we find some poor results for Jack in the Box. In that comparison with the S&P 500, $10,000 invested in Jack in the Box would have shrunk to $8,141 or a -4% CAGR versus $21,877 or a 16% CAGR if invested in the S&P 500. This demonstrates underperformance for Jack in the Box. A Jack in the Box investment would have also been much more volatile, with a 52% standard deviation versus 18% for the S&P 500. Jack in the Box underperformed the S&P 500 in terms of the best year performance, for which Jack in the Box grew 22% versus S&P 500 31%, and worst year performance where Jack in the Box fell 30% versus the S&P 500 18% fall. In terms of max drawdown, Jack in the Box fell 61%, more than the max drawdown of 24% for the S&P 500. Jack in the Box also massively underperformed the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. Jack in the Box has been trailing the S&P 500 for a long time by nearly every metric. Now let's hop over to market share and take a look at Jack in the Box's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that Jack in the Box is categorized under fast food restaurants. Expanding the fast food restaurants tab, we can see that Jack in the Box has the 5th smallest market share and does not appear to be growing. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Jack in the Box and see that the market share is 0.13% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Jack in the Box attracts very little food spend. The 5-year market share CAGR for Jack in the Box is 0.05%. This means that Jack in the Box's market share is barely keeping up with industry growth. If we start in 2019, we see that the market share was 0.13%, 0.14% in 2020, 0.14% in 2021, 0.16% in 2022, and back down to 0.13% over the trailing 12 months. No good signs from the market share trends over time for Jack in the Box. In this version of market share, we can also compare Jack in the Box with other companies or entire industries. When we type in SHAK, the ticker symbol for close competitor Shake Shack, we can compare the market share data for the two companies. While Jack in the Box holds a 54% share of restaurant spend between the two restaurants, it is losing market share to Shake Shack on the order of losing just over 3% of its market share per year to Shake Shack. To put that another way, Shake Shack is eating Jack in the Box's lunch. Let's take a look at the fundamentals to learn more. Gross margin is 30%. This is on par with similar restaurants. Revenue has compounded at around 14% over the past 5 years and has reached over $1.65 billion most recently. Jack in the Box's revenue is growing just enough to keep in pace with the industry, but this will not allow the share price to outperform over time. Looking at cash flow, we see a -6% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 16% CAGR. As a result, free cash flow has fallen at a 23% CAGR. Jack in the Box has some really problems here. With shrinking operating cash flow and growing capex, the company may be at risk of free cash flow flipping negative soon. Management should probably rethink their capex allocation strategy. Weighted average shares outstanding have fallen over the last 5 years, going from 26.1 million shares in 2019 to 20.5 million shares most recently. Jack in the Box has been buying back shares. While share buybacks are great, I do prefer to see them in the context of growing free cash flow. I am not convinced that share buybacks can continue much longer. We even see management begin to realize this with slowing buybacks, as we can see in the chart. Now let's view return on invested capital. Return on invested capital has fallen from a respectable 21.4% in 2019 to a dismal 5.9% in 2023. This is not ideal. Jack in the Box has become less efficient in driving profits from its investments. However, as we saw in the free cash flow section, they are continuing to invest. This may end up being a big problem for the company. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from -11 days in 2019 to -5 days most recently, Jack in the Box has gotten less efficient over time. The good news is that this value remains negative and has actually been improving since 2021. Hopefully this trend continues. Now, let's look at Jack in the Box's debt. The net debt to EBITDA has increased over the past 5 years, going from 4.4 in 2019 to 9.9 most recently. This is a very high debt level. I presume that Jack in the Box is taking on debt to fund share buybacks and dividends as their free cash flow continues to diminish. With that amazing segue, let's explore dividends. Current dividend yield is 3.3% with a dividend payout ratio of 31%. Jack in the Box is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Dividends per share for this company have grown at a 13.6% dividend per share CAGR over the past 3 years and a 1.9% dividend per share CAGR over the past 5 years. I am actually surprised to see that the payout ratio is reasonable. However, this raises some questions. Why does management have such a massive debt load if not to find dividends? In any event, should it be added to the watch list? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Jack in the Box. It is a restaurant company with a gross margin of 30%. The 5-year revenue per share CAGR is 20% and the 5-year free cash flow per share CAGR is -18%. Despite a decent gross margin and fair revenue growth, the declining free cash flow is clearly a problem. A return on invested capital of 6% is low and falling. This is not good. Next, the cash conversion cycle of -5 days is not bad and the recent trend is hopeful. Concerning debt, a net debt to EBITDA of 9.9 means that it would take Jack in the Box nearly 10 years of earnings to pay back their debt. So from a fundamental standpoint, Jack in the Box does not look good. Now let's switch our attention over to valuation. Jack in the Box is massively undervalued relative to the S&P 500 with a ratio of 0.3. The price to earnings growth, or PEG ratio, is one indicating that Jack in the Box is fairly valued relative to their projected earnings growth. Jack in the Box is an interesting company. They operate in a very competitive restaurant space with burgers and fries being their primary offerings. Yet the company has survived for decades. To me, this shows that companies don't have to be great to survive. They don't have to have growing revenue and free cash flow every quarter while expanding market share and return on invested capital. However, while these companies may not go out of business, their share price returns are horrible. I am looking for thriving companies, not just survivors. I like to see growing market share, free cash flow, and return on invested capital. One of the biggest challenges for Jack in the Box is its poor return on invested capital. For any company, capex investment often takes years before investors can see if the investment generates positive returns. For Jack in the Box, rising capex represents major investment in the capital, property and/or equipment for the company. For restaurants, this is typically associated with expansion plans. However, as we can see with falling free cash flow and return on invested capital, this investment plan has yet to yield results for Jack in the Box, and it may never. And I do not have the patience to wait around to see if it does yield good results someday. There are other companies that have much better expected returns. For me, Jack in the Box is not going on the watch list. Many thanks for watching. What do you think about Jack in the Box and companies surviving versus thriving? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.